Staying ahead of the curve means understanding the big picture, right?
Right.
And right now, that picture is, well, it's heavily focused on hitting those global climate goals.
Mm-hmm.
Carbon markets are a key part of that, even if, they can seem a bit complex sometimes.
They definitely can be.
And we're really hurtling towards 2030. That's a huge deadline under the Paris Agreement.
It is, and loads of Fortune 500 companies have similar targets too.
It feels like a really pivotal moment.
It really does. That 2030 timeline, it's creating such a powerful push for change.
So understanding how the tools like carbon markets are evolving, that's vital.
Absolutely essential for anyone watching this space.
Exactly. So for this deep dive, we're going to focus our attention on the carbon market, how it's shaping up for, say, 2025.
Good plan.
Our guide here is a really insightful article from Forbes Business Council. It's called 2025 Carbon Market, 3 Things to Watch.
Okay.
Penned by Jamie Houston. He's the CEO of Aurora Sustainable Lands.
Ah, right. They manage a lot of forest land, don't they?
A huge amount. 1.65 million acres of U.S. forest land, specifically for climate mitigation.
Wow.
And here's the thing, his perspective is valuable because they're not just talking theory. They do this.
They're actively managing land for this purpose.
Yeah, and their carbon projects, they're registered with the American Carbon Registry, the ACR.
Okay, so he's really in the trenches. That direct experience, especially with ACR certification, that gives his insights real weight.
Right. The American Carbon Registry. Maybe just quickly explain what that is.
Sure. It's one of the main independent bodies in the U.S. They set the standards, they verify the quality of carbon offset projects, make sure they're legit.
Got it. So that's what made this article really stand out for us.
Makes sense.
Our mission for this deep dive is to really, dig into the key trends Houston points out.
What should we be watching?
Exactly. What are the crucial shifts in carbon markets we need to be aware of, especially with 2030 getting closer?
And corporate sustainability just keeps climbing the priority list.
Definitely. So the first major trend he flags, it's the rising demand for carbon offsets as we head towards 2030.
Which feels pretty intuitive on the face of it.
Yeah, you'd expect that, wouldn't you?
You would. It's just driven by the sheer number of climate commitments already made.
So many companies across all sorts of industry.
They've set these ambitious targets, and the clock is ticking down to 2030.
The pressure to show real results is really mounting.
Significantly.
But here's a twist. This is where it gets really interesting, I think.
Okay.
Houston brings up this, unexpected surge in energy consumption.
Oh, from what?
It's fueled by the massive growth of AI, artificial intelligence, and the huge data centers needed to power it.
Ah, right. That makes sense. The energy footprint of AI is becoming a huge topic.
Apparently, some projections suggest the energy demand might have been seriously underestimated.
Seriously underestimated? What kind of numbers are we talking about?
Well, he doesn't give exact figures in the article, but the implication is significant.
Yeah. Some forecasts predict an almost exponential increase in energy needs as AI models get more complex, more widespread.
All that computing power for training, for running them.
And the infrastructure, those data centers. It all adds up.
So if those projections are even close to right, what does that mean for carbon markets?
This could be huge. This extra demand could put serious upward pressure on offset prices.
Especially for certain types.
Potentially. Maybe those readily available reduction credits first? And companies relying on avoidance credits, they might find themselves competing hard with these really energy-hungry sectors.
So it's like a double whammy. Existing climate goals, PLUS, this new, maybe underestimated demand.
Exactly. That could really shake things up.
But, okay, Houston also points to something positive on the supply side.
Good. What's that?
It's getting clearer what actually makes a high-quality carbon credit.
Ah, the quality issue. That's crucial.
He mentions the Integrity Council for the Voluntary Carbon Market, their core carbon principles.
Yes, the ICVCM, setting that global benchmark.
And also the American Carbon Registry's new standard, 2.1, specifically for forest carbon projects.
Right, so better guidance, clearer standards, that's definitely positive.
It sounds like a move towards maybe more trust, more clarity.
Absolutely. The credibility of these credits is everything. If the market's going to work effectively,
You need that trust.
you do. Clear guidelines, robust standards like the CCPs, the updated ACR standard, probably includes tougher rules for, how long the carbon stays locked up, things like that.
Permanence, right?
It's all essential for building confidence among buyers, making sure the money is actually leading to real climate action.
Okay, so we have this rising demand, maybe unexpectedly high demand.
And a stronger focus on quality.
Right. So what can businesses actually do? How do they navigate this? Houston gives 3 strategies.
Okay, let's hear them.
First one, secure long-term offtake contracts with carbon credit providers.
Smart. That's thinking ahead.
How does that help exactly?
Well, by locking in these long-term deals, companies basically guarantee a future supply of credits.
At a set price.
Often, yes, at a predictable price. It's a hedge against those potential price hikes and supply shortages as 2030 gets closer.
And you can tailor them too.
That's the other benefit. You can structure these contracts to fit your specific internal goals. Make sure the credits really align with what your company needs.
Okay, strategy 1, long-term contracts. Lock it in. What's number 2?
His second idea is diversification.
Don't put all your eggs in one basket.
Pretty much. Invest in a mix. Some nature-based solutions. Think forestry, soil carbon.
Like the stuff his company does.
Right. And also technology-based solutions. Things like direct air capture.
Why is the mix so important? Why not just go all in on, say, trees?
Because relying too heavily on just one type exposes you to risk.
Like what?
Supply problems, maybe prices shoot up for that specific type. Maybe the science evolves on how effective one method is versus another.
Oh, yeah.
A mix of nature-based, which often give you those nice co-benefits like biodiversity.
We'll come back to that.
And tech-based removals, which might offer more, let's say, verifiable permanence. That just creates a stronger, more resilient strategy overall.
Makes sense. Balance the portfolio. And the third strategy?
Strategic partnerships.
With whom?
Collaborations with conservation groups or research institutions.
How does partnering up give businesses an edge here?
It can give them early access. Access to cutting-edge climate solutions, new methods that maybe aren't widely available yet.
Sort of getting in on the ground floor.
Exactly. It's a way to stay ahead of the curve,
Yeah.
maybe even influence how new tech or nature approaches develop. And it shows leadership.
Okay, 3 solid strategies there. Long-term deals, diversify, partner up.
Seems like sound advice in a shifting market.
Right. Let's pivot now to the second big trend Houston talks about.
Okay.
It's the growing importance of valuing both carbon and biodiversity.
Yes. This is becoming increasingly prominent.
We've talked a lot about carbon, obviously, but he argues biodiversity is kind of the next critical frontier for corporate sustainability. Why the bigger focus now?
I think it reflects a much deeper understanding of how interconnected everything is. Climate change and biodiversity loss. They're 2 sides of the same coin, really.
How so?
The UN has been pretty clear on this. Biodiversity isn't just, nice to have. It's a fundamental defense against climate change.
A defense.
Yeah. Healthy, functioning ecosystems. They're vital for soaking up carbon, for resilience to climate impacts, for providing all sorts of essential services we rely on.
And it sounds like the people buying carbon credits are starting to expect more now.
They are. It's not just about tons of CO2 anymore.
They want projects that also deliver real, measurable biodiversity benefits.
Exactly. What's driving that shift in what buyers want?
Well, I think it's just a natural evolution in understanding.
Mm-hmm.
As we learn more about the complex web of life, how vital biodiversity is for keeping the planet healthy, the value of projects that do more than just store carbon becomes clearer.
Right. Buyers are realizing that projects protecting or enhancing biodiversity are probably going to be more robust.
More sustainable.
Yeah, and ultimately more impactful in the long run. They offer those valuable co-benefits.
Houston mentions that big global climate meetings, like the COP conferences.
Right, the Conference of the Parties.
Upcoming decisions there could really speed things up, maybe create actual biodiversity credit markets.
Or integrate biodiversity value into existing carbon projects somehow.
What might that actually look like? I mean, how do you even put a value on biodiversity in a way you can trade? That sounds tricky.
It is tricky. Those are the big questions people are grappling with right now.
Practical hurdles.
Definitely. Formalizing it could mean creating specific metrics, standards for quantifying biodiversity gains or avoided losses from a project.
So you could end up with tradable biodiversity credits, like carbon credits?
Potentially. Or maybe biodiversity scores get factored into the price or evaluation of carbon projects.
But the challenge is establishing metrics everyone agrees on, proving additionality that the biodiversity benefit wouldn't have happened anyway.
And building robust systems for verification and trading. It's complex. But decisions at COP could give it a real push, provide those international frameworks we need.
So for businesses wanting to, get proactive on this, what does Houston suggest? He's got 3 action items.
Okay.
First, use frameworks like the Task Force on Nature-Related Financial Disclosures, TNFD.
The TNFD. Similar to the TCFD for climate.
Right. For someone not familiar, what's the basic idea behind TNFD? Why now?
The core idea is to give businesses a structure, a way to understand, assess, and then disclose their impacts and dependencies on nature.
Just like TCFD did for climate risks.
Exactly the same principle. It's important now because investors, regulators, the public, they're increasingly seeing the financial risks tied to nature loss.
So they're demanding more transparency from companies.
Precisely. Greater accountability.
Okay, second step he mentions, investing in biodiversity-friendly infrastructure.
Like what?
Things like green buildings, creating wildlife corridors, especially in developed areas. How do those help?
Well, they show a commitment to integrating nature into the business itself, into the built environment.
Okay.
Green buildings can have features like green roofs, walls that support local wildlife. Wildlife corridors connect habitat that have been broken up, letting species move around.
So it directly helps biodiversity.
And it boosts the company's green credentials.
Yeah.
Can make places nicer for communities, too.
Right. And his third suggestion, collaborating with environmental groups and government agencies.
On bigger projects.
Yeah, larger scale stuff. Ecosystem restoration, protecting endangered species, reforestation efforts. What's the upside of teaming up?
Collaboration lets businesses tap into expertise. These organizations often know the local ecosystems, the conservation needs, inside out.
Leverage their knowledge and resources.
Right. And it allows companies to be part of projects with a bigger impact, landscape level impact, maybe more than they could do alone.
Plus, good for reputation, building trust.
Definitely. Builds credibility with stakeholders.
Okay, moving to the third key trend Houston highlights. He calls it climate powerhouses.
Climate powerhouses. Intriguing.
It's all about how land management is evolving, focusing on delivering multiple benefits, not just one.
Oh, okay. Moving beyond just carbon storage.
Exactly. What's driving that shift towards a more integrated approach?
It's really a growing recognition that land is just critical. For climate, yes, but also for so many other environmental challenges.
Water, biodiversity.
Exactly. Sustainable land management can soak up carbon, boost biodiversity, improve water quality, make ecosystems more resilient. The focus now is finding ways to maximize all those benefits together.
Not just optimizing for one single thing.
Right. A more holistic view.
He gives some really practical examples. Agroforestry.
Combining farming with trees.
Yeah, sustainable agriculture plus carbon storage. Regenerative grazing.
Improving soil health on grasslands, storing more carbon there.
And restoring or conserving wetlands and forests. He points out they're vital for carbon capture, obviously, but also water management.
Natural filters regulating water flow, absolutely crucial.
These sound like really sensible, multifaceted solutions.
They really are. These dual-purpose or multi-purpose solutions are just a more holistic, more efficient way to manage land.
Agroforestry boosts harvests and stores carbon.
Regenerative grazing restores land and stores carbon, and can improve livestock health.
Wetland and forest restoration.
Yeah.
Massive carbon sinks plus biodiversity havens plus water benefits.
Ticks a lot of boxes.
And for businesses, Houston stresses that these approaches let them hit multiple sustainability goals at once.
Protect ecosystems, cut emissions.
Maybe even help the renewable energy transition through sustainable biomass, all under one strategy.
It's about maximizing efficiency and impact, getting more bang for your sustainability buck, so to speak.
Precisely. It's a smarter, more integrated way to operate, aligning environmental action with business goals.
Recognizing that these environmental challenges are all linked.
Okay, so those are the three big trends. Now, beyond those, Houston also gives some very practical tips for business leaders actually thinking about investing in carbon offsets.
Which is useful, because it can definitely feel like a complicated market. A bit murky sometimes.
Totally. So his first piece of advice: understand the different types of credits.
Removal, reduction, avoidance, they're not all the same.
And make sure they actually align with your company's specific climate goals. Can you quickly recap the difference? Removal, reduction, avoidance.
Sure. Removal credits come from activities that actively pull existing CO2 out of the air. Think direct air capture machines or planting new forests, afforestation.
Taking carbon out. Got it.
Reduction credits are from projects that lower emissions compared to what would have happened otherwise a baseline, like switching a factory to renewable energy instead of fossil fuels.
Lowering new emissions.
Right. And avoidance credits basically prevent emissions that were going to happen. The classic example is protecting existing forest that was slated to be cut down, sometimes called conservation credits.
Preventing emissions. Okay. And why is matching them to goals so crucial?
because they have different impacts, different levels of permanence, different costs. You need to be clear about what you're trying to achieve. Are you neutralizing existing emissions? Reducing your footprint going forward? Protecting vital ecosystems? The type of credit matters.
Good point. He also says, look beyond just the carbon.
Evaluate the co-benefits.
Right. How does the project impact local communities? Biodiversity, water quality, the whole ecosystem.
Take that wider view.
Why is that holistic evaluation so important?
It helps ensure your investment is creating real, lasting, positive change. Not just, ticking a carbon box on paper.
Avoids unintended consequences.
Potentially.
Yeah.
And it strengthens your company's whole sustainability story. Shows you're contributing positively beyond just carbon.
And this feels key. He strongly recommends following guidance from established bodies, like the Integrity Council for the Voluntary Carbon Market we mentioned earlier.
Absolutely critical advice.
Why is sticking to those guidelines so important? What do they actually ensure?
Adhering to best practices and standards from groups like the ICVCM is crucial for credibility, for effectiveness.
Make sure the credits are real.
Essentially, yes.
Yeah.
They help verify the integrity, the additionality.
Additionality again. That means the carbon reduction wouldn't have happened anyway without the project.
Exactly. It has to be additional to business as usual. Following these guidelines helps avoid accusations of greenwashing. It gives confidence that the investments are genuinely leading to measurable climate action.
Okay. And his final tip, diversification again.
But this time, for your offset investments.
Right. Spread investments across different project types, different sectors, even different parts of the world. Why diversify the offset portfolio itself?
Same principle as diversifying your strategy. It mitigates risk.
Risk of what?
A specific project failing, maybe policy changes in one region affect certain credit types, maybe there's a fire or a flood, unforeseen events.
Don't put all your carbon eggs in one project basket.
Exactly. Diversification makes your portfolio more resilient. Plus, it lets you support a wider range of cool projects, different environmental and social outcomes. Helps build a stronger market overall.
Okay, that's really practical advice. As we start to wrap up, Houston shares a couple of interesting findings about the future outlook.
Oh, yeah.
He mentions research showing that most companies, like 85%, plan to keep doing their climate disclosures.
That's encouraging. Transparency is key.
And also, a majority of U.S. consumers actually want to hear more about what companies are doing on sustainability.
That's significant, too. Consumer demand is a powerful driver.
What do those 2 points suggest to you about where things are generally heading?
Well, they suggest businesses are increasingly recognizing that transparency and accountability on climate aren't optional anymore.
It's becoming expected.
Right. And the consumer piece shows that these efforts aren't just about responsibility. They're actually factoring into trust, into purchasing decisions. It matters to people.
And his final thought in the article is quite powerful, I thought. He suggests that for business leaders, sustainability is really shifting. It's moving beyond just being a public commitment, something you say you'll do.
It's becoming what?
To becoming a fundamental strategic advantage, something that actually drives resilience and helps long-term growth, especially in a world being reshaped by climate change.
That's a really insightful way to frame it. It's not just a cost center or compliance checkbox anymore.
It's core strategy.
Yeah, a driver of innovation, efficiency, competitiveness. That's a big shift in thinking.
Okay, so let's quickly recap the main takeaways from our deep dive into Jamie Houston's article.
Let's hear it.
We looked at trend 1, that rising demand for carbon offsets, driven by 2030 targets, but also maybe this unexpected AI energy surge.
Trend 2, the growing importance of biodiversity. Valuing it alongside carbon and corporate sustainability plans, expecting projects to deliver both.
And trend 3, those climate powerhouses. Land management evolving to deliver multiple benefits, carbon, water, biodiversity all at once.
We touched on those practical tips for businesses navigating the market. Understand credit types, look at co-benefits, follow quality standards, diversify investments.
So why does all this matter to you, listening in?
Well, staying informed about these shifts isn't just, keeping up with headlines. It's about understanding the deep currents shaping the future of business, finance, and environmental action.
We've seen how complex climate goals, fast tech changes like AI, and fundamental ecological needs are all starting to interact in new ways.
It's those aha moments, seeing how the pieces fit together, that give you that clearer picture of what's coming down the track.
Absolutely. So maybe here's a final thought to leave you with.
Okay.
How might this growing push to value both carbon and biodiversity truly reshape how we think about economic value and environmental value in the coming years.
Could we be moving towards solutions that don't just tackle climate change, but actually genuinely enrich the natural world at the same time?
Imagine that. Truly groundbreaking solutions that achieve both. Definitely something to think about.